Hey there, welcome to the channel. Most people know that a mortgage payment is comprised of two parts, principal and interest. The principal portion of the payment goes back to paying the money that you borrowed. For example, if you borrowed $400,000, the principal portion of the payment goes towards paying back that $400,000. The interest portion of the payment, that is your charge for doing the loan. I know a lot of people think the closing costs are the charges, but that interest portion of the payment, that's the real charge for doing the loan. Now, there's a feature called interest only. This interest only feature is available on both first mortgages and home equity lines of credit. Now, this interest only feature, well, just like its name says, allows you to pay the interest portion of the loan only in order to get a lower payment. But you can do this only for a limited period of time. For example, on first mortgages, they have 3-year, 5-year, 7-year, and 10-year interest only periods. And on home equity lines of credit, it's typically a 10-year interest only period. The rest of the loan is for paying everything back. For example, a lot of home equity lines of credit have a 10-year interest only period and then 10 years where you have to pay it back for a total of 20 years. First 10 years you can draw on the line of credit, and the last 10 years are for paying back the loan. Same thing with the first mortgages. So there's some characters running around on the internet confusing interest only with simple interest. And they're telling people that you could use a home equity line of credit to pay off a first mortgage in 5 to 7 years without changing your budget, which is freaking bananas. They're saying this because they're calling a home equity line of credit simple interest, which it is, but they're calling it simple interest because of that interest only feature. And they're saying that first mortgages are amortized interest, which there's no such damn thing. There are amortized loans, not an amortized form of interest. And I outlined this in detail in the 3 videos that I made on how using a home equity line of credit to pay off a first mortgage faster is BS. Now, in addition to first mortgages and home equity lines of credit, both being simple interest, what these characters either don't know or fail to disclose is that both first mortgages and home equity lines of credit are amortized. Oh, yes, indeedy. After that first 10 years on that home equity line of credit, remember what I told you a couple minutes ago? The last portion of the loan is designed for payback, whether it be a 10-year payback, 15-year payback, or a 20-year payback. And at that period, when it changes to a payback, we call it the recast, the loan becomes fully amortized, because if it didn't, you would never pay it back. So you've got that interest only payment for that first 10 years. And after that, it becomes, the payment increases and it becomes a fully amortized loan, just like the first mortgages. So that was the interest only simple interest mix up. Pay your home off in 5 to 7 years by using a home equity line of credit. BS mystery solved in 3 minutes. Thanks for watching, and I'll see you on the next one.